Good evening. Today's lecture is going to be on equity. If you recall, we have been looking at different components of financial planning. So we've already looked at insurance. We've had a look at mutual funds, and the next stop is equity. Now, when we speak about equity, I will be telling you about some of the basic ways in which we can analyze companies and the stock markets and then take a decision with regard to investing. I am not, let's be clear about this. There is no attempt here to recommend any stocks or anything of that sort. The basic idea is that you get an understanding of what different companies, how they actually function, and have an idea about the different parameters with which you can actually analyze a company, to understand its performance. And then on that basis, it is for you to take a decision with regarding to whether you want to invest or not. Different people have different goals. So depending on, they have different risk capacities. These are things that we have discussed when we began the session on financial planning. So what you need to do is you look at your own particular profile, what you want to do, look at your goals, look at your risk capacity, look at the liabilities that you already have. And keeping all that in mind, you take a decision with regard to investing. Equity investing, let's remember, is risky and should only be approached after a proper understanding of the subject. And basically what we're trying to do here is trying to get a better understanding of this field. So let me just share this presentation here so that you have and I can take you through this entire presentation, and hopefully you'll get a very good idea about what exactly equity investing is, and you can then begin to figure out how you want to approach this. So let's start with at the usual place. Okay, how do we define equity? So as far as equity is concerned, see, if you look at Investopedia, let's say you just Google this, and one of the first definitions you will get will come from a very well-known site called Investopedia. Anything related to finance, you will find very handy definitions here. So equity represents the value that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debts were paid off. So sounds a little complicated. So let's think of it this way. Each individual shareholder owns the company to the extent of the number of shares she has. Hence, they are known as equity shares. Now, once a share is bought, there is no way of selling that share back to the company unless the company itself initiates something called a buyback, where it actually wants to buy back the shares that it has sold. Otherwise, any equity capital which the company receives is essentially long-term capital and the basis for the activities of the company. They aren't going to return that. If we want to sell our own equity, we find another buyer who's interested in entering the company and we sell our stock to him. So when I use the word stock, let's think of it as synonymous with equity. We won't fool around with different definitions of stock and equity here. Let's just think of them as the same thing. So if a person has bought a share in a company, that person is a shareholder. And if you don't intend to sell the share to someone else, if you don't intend to do that, then you will continue to remain a shareholder of that company and receive dividends whenever they declare a dividend for as long as that company exists. When that company finally comes to an end, at that point of time, the assets of the company will be liquidated, converted into money, and from the proceeds, the money which the liquidators get, they will distribute those proceeds to everybody to whom the company owes money. So the debtors will get the money first. The persons who had loaned money to the company, those are the creditors, they will get the money first. And the shareholders will get the money last based on what remains. So it's very possible that if it comes to this particular juncture where the company has to be sold and at that point of liquidated and then money has to be returned to you, then it's very possible that you will get back even less than you had actually invested. So there is a very definite risk here when you actually invest in equity. Now, let's now try to understand what exactly happens, how a company is actually set up. Starting a company, let's take a very basic example and then try to understand how this actually works. So let's say Ramesh and Mahesh, these are two individuals, and they want to start a company. And they have 5 lakh rupees, and they say this is going to be the total amount of capital which this company will need. So we'll both contribute 5 lakhs and we'll start. They have a business plan. So it'll be something like this. In the year 2018, Ramesh, Mahesh, both contributing 5 lakhs. They both take 50,000 shares in their company, and they price each share at rupees 10. So essentially what happens? The company which is formed, the Ramesh and Company Private Limited, this now has a share capital of 10 lakhs. And in terms of number of shares that have been issued by this company, it's 1 lakh shares. 50,000 of those shares are with Ramesh, 50,000 of the shares are with Mahesh. They're equal shareholders in the company. Now let's say that over a course of time, Ramesh and Company makes a profit of 10 crores. I'm deliberately taking a higher figure so that you begin to understand how the value of the company can actually change if the profits are good. So let's say they make a profit of 10 crores. So now if you take 10 crores and you try to find out what the earning per share is, take 10 crores divided by 1 lakh, you'll get 1,000 rupees. So the per share earnings, profit divided by the number of shares. Earnings is just another word for profit. So the earnings per share is rupees 1,000. So it's something like this now. Capital is 10 lakhs. Price per share is 10. Reserves, the profit that it earned on the balance sheet. We've discussed the balance sheet before. So on the balance sheet, the profit that the company makes every year, that is appropriated and it is reflected under the item reserves. So on the balance sheet, all the items that appear are referred to as line items. Reserves is normally the second item that you will see. After you've seen the capital itself, you will see reserves, and this is where the profit is actually reflected. So in this particular case, the reserves are 10 crores. Capital here is 10 lakhs. So the net worth of the company is basically, or let's say the shareholder funds of the company is 10 crore, 10 lakhs. Earnings per share, as we mentioned, is 1,000 rupees per share. The number of shares remains 1 lakh. Now, Ramesh and Company now submit themselves to a valuation. They go to a valuer and they ask the valuer to basically have a look at their company and to assess what this company should be worth in the market. It's a theoretical exercise. Based on the sort of business that we have, based on the financial results that we have shown, what should be our value? And it's valued at 15 times its earnings, or 150 crores. Now, the idea is that this company, including its future earnings, would be worth 150 crores. So anybody buying this company lock, stock and barrel, the full company, if it's bought by someone, basically this person over the life of the company is likely to earn 150 crores at least. So that is basically what they are assessing the company to be, 15 times of its earnings. Earnings are 10 crores, 15 times 10, 150 crores. Now, if you take 150 crores as the value of the company, and it has 1 lakh, let's say number of shares is 1 lakh, then there are certain other things that we can calculate on that basis. So the earnings are 10 crores. The P ratio would be 15. That's 150 divided by the earnings, price to earnings. So the value of the company would be the price. The earnings are rupees 10 crores. So the PE ratio is 15. The number of shares, remember, is 1 lakh. So the price per share is 150 crores divided by 1 lakh, which basically gives you rupees 15,000 per share based on the valuation of the company. So what you can see right away is that whereas the price per share, the book value of the share, when they began the company, the face value of the share was rupees 10. But as the company basically made profits, as it made profits and its valuation went up, the price per share in terms of that value becomes rupees 15,000. So now I repeat this little diagram here for you. So now let's say the two shareholders decide to give themselves a bonus of 99:1. Remember, there are just two shareholders here. So Ramesh, the number of shares he has is 50,000. The bonus shares, 99 times this. So 49 lakh 50,000. And the total number of shares will become 50 lakhs. Original shares, 99 times of this is the bonus share. And ultimately Ramesh, like Mahesh, becomes the owner of 50,000 shares. So what they've basically done is they have increased the number of shares. And why have they done that? Because they want this company, the shares, to be tradable. It should be low enough for people to be interested in buying it. If you price a single share at 15,000, the number of people who would be interested in actually buying that share is going to be less. As against, so it's easier for people to think of making an investment, buying more shares in this company if the price is rupees 150. So just to sort of look at this again, the total shares are 10 crores. The value of the company is 150 crores. And the price per share is rupees 150. Now, the company goes for an IPO of rupees 60 crores. Basically, what the company is doing now is they are taking a chunk of their company and they are selling it to anybody who's interested in buying it. So they're coming out with an offer. Look, we are offering you our shares at rupees 150 apiece. And this, we need 60 crores. We have a good business model, so come and invest. 40 lakh shares are issued at the rate of rupees 150 each. So this is the number of shares which investors are offered by the company. And let's say that they actually decide to buy and the shares are subscribed. What will happen is the company is going to get 60 crores more as capital, and they will take these 40 lakh shares. Remember, they had this entire amount, these 1 crore shares here. They will take 40 lakh shares and they will sell that to these new shareholders. Now, the moment they do this, the company gains additional capital of 60 crores, but it also now has to look at the interests of all these different shareholders. So the board of directors will be there in the company. Right now, the board of directors has just these two people, and they'll be running this company. And they will run it now for the benefit, not just of themselves, but also of the new investors who have come on. So that's how basically the company is going to operate. Going forward, this company shares will be traded on the stock market, and all these shareholders are free to sell their shares on the stock market or pick up new shares from people interested in buying. And this process will go on and on as long as the company continues to be in business. That is the way it works. Now, let's try to understand this PE ratio. So here we had a PE ratio of 15. So how exactly does this work? So basically, there are two variables here. There is price, and the other one is the earnings per share or the profit per share. So the total earnings divided by the number of shares gives you the earnings per share. And if I now take the price and divide it by this, I end up with the PE ratio. So a company has an EPS of rupees 10. It grows by 15% each year. If I link price with EPS, I can say that price should be rupees 150. So that's the logic in the valuation which we saw a little ahead. So if you were to put this into a chart, it would look like this. So we have the years here, the growth rate, the growth amount, and the profit. So let's say in year one, after a growth rate of 15%, they get a rupees 10 profit. Year two, 15% again. This time, this rupees 10 plus the 150 extra, which the company gets because it's growing at 15%. So you add 150 to the 10 and you get 1150. Year three, you take 15% of 1150, you get 173. Add that to the 1150, you get 1323. The profit is here. Now, if you continue with this for 10 years, you at the end of the day, you get 203.04 in profit in a period of 10 years. So in 10 years, I have got back rupees 203, and the price of the share would also have appreciated. So the logic here is that when I have a P ratio of 15, this is what I mean. Over a period of time, every year, the company is going to keep adding to its profits at the rate of 15%. And cumulatively, this is the sort of the profit that I am going to earn from my investment. Apart from that, the share itself will, if the company is doing well, and if there is a demand for its shares, then the shares itself would have also appreciated in value. So if you bought it initially at, let's say, rupees 150, the share value by this time would have increased to many times that number. Because of the steady profits, a large number of people would now be interested in actually investing in this company. Now, there are some situations where this PE ratio may not actually work. So there are some industries which are known as cyclical industries. That is, these industries do well when the economy itself is doing well, and they don't do that well when the economy is not doing well and is in a depression or in a recession. So some examples of these cyclical industries are steel, petrochemicals, tires, sugar. And so look at this, 2006, steel is booming. Tata Steel buys Chorus, then steel prices fall. Tata's investment becomes a burden. And this becomes a problem for the Tatas. So because it is essentially in a cyclical industry, and if it feels that, that the sector is booming and it will continue to boom, that is, the business cycle is going to remain the way it is for a fairly long period in the future, and you make an investment. And if the cycle at that point of time goes into reverse gear, then you stand to lose a lot. And that is the problem with all cyclical industries. So P ratios will, of course, if somebody had predicted that, let's say, Chorus is going to do 15% continuously for the next 10 years, business cycle changes, Chorus will no longer be able to get 15%. It will be very hard for it to even get a profit if things change. Now, so it looks something like this. The stock market is at a normal level. Stock market booms due to economic growth. It goes up. So let's look at this trend line here. It's going up. The economic growth slows down. Stock market returns to normalcy, comes back to normal, more or less the level it was. And let's say after this, the stock market goes down, it crashes. So a cyclical industry would broadly, its share prices would follow this trend line. This is the way it would actually move. It would not move in the way we described it in the earlier slide, where we were trying to give you an idea about how P ratio actually works. So there are problems with P ratio. You can't use it for all industries. What this basically tells us is that we need to understand in what industry we propose to invest. So the shares of all industries, the share prices of all industries do not move in the same manner. Some of them are cyclical and could move in this manner, in which case I need to focus more on the way the economy itself is behaving. Because if the economy is going to behave well, if it's doing well, then these industries are likely to do well. Then let's say that economic growth is restored and the stock market returns to normalcy. These share prices would also in due course return to normalcy. So it's a fairly rough ride in a cyclical industry. Once again, the point for you is that before you actually invest, be sure to understand what type of industry you are investing in. Okay. You can also think of it like this. Think of the trend line as representing the movement of the Sensex and Nifty. Overall, the Sensex or Nifty would also be moving along these lines, because the companies that they have, they are a good measure of the economy as a whole, and they give you an idea about the economy. Now, so let's have a look at this then. So now that we've seen one type of stock, cyclical stocks, let's have a look at the other types of stocks that are there, so that we get an idea about what these different types of stocks are, and that helps us to go ahead with our investment. So let's say we take blue chip stocks. What are blue chip stocks? So these are stocks of well-established companies, and generally they are considered safe. So such companies have history of stable earnings, dividend payments. So these companies have been in the business for a very long time. They know the game. They generally have a decent market share. They have professional management. So these companies, if you invest here, chances are that you won't be at risk of losing your capital over a long term. See, one thing we should remember in stocks, that the fortunes of a company, that is its profits, may fluctuate from year to year. In which case, because, or let's say its performance may be very different from the expectations that the market has of the company. And whenever its performance is not in terms of the expectations of the market, there is generally a feeling that this company isn't performing so well, and people may sell their shares. in which case the share prices of the company can actually go down. So even in the case of a blue chip company, the volatility of the shares will be there. There will be cases where the share prices will come down and it may take a little time to come up again. But the basic rule is that if I have chosen a good company, something with a good, let's say a good pedigree, something which has been doing well for a long period of time, if I stay with that company, then the chances are that I will actually make a lot of money. It requires patience and it requires belief in the company. Now, the other type of company is income stocks. So these pay higher than average dividends. So companies with steady, predictable sources of income. So utility companies, power companies, gas companies, water companies, these companies which basically send bills to their customers every month. They sell a commodity or something which is absolutely essential for day-to-day living, let's say electricity, and people pay them. So because of that, they have a steady income. And because they have this very predictable source of income, it is possible for them to generally make regular profits and pay regular dividends. So if the purpose of the investment is to basically earn from dividends, then it makes sense to invest in income stocks. So if you're getting dividends, it also means that the company is performing as expected, in which case the demand for their shares will also be there, and there should be a capital appreciation of your investment. That basically means that the prices of the shares would also keep going up. So if that happens, then you gain both ways. You get a regular dividend also, and then when you want to exit the investment, you can sell those shares at a higher price. Now there's this third type, growth stocks. Such companies have the potential to give the highest growth. So key factors are an expanding product line, quality merchandise, a good R&D department, but these companies may not actually be paying dividends. See, when a company makes a profit, it has an option. The option is I take the profit and I reinvest it in the company. Or I take part of the profit, I reinvest that, and the other part I basically give to my shareholders as dividend. Now, given a company which, let's say, is doing well, it's having a let's say a great run on the markets, its products are selling well, it's expanding its product line, such a company needs money for further expansion. So to fuel that expansion, possibly it may not actually pay dividends or pay low dividends and take the bulk of the profit that it makes every year and pump that into its expanding product line and in expanding the company itself. So if that is the case, what will happen is that the company share prices are going to do very well. Company is doing well, market is going to pick up on the cues. There'll be lots of people who will be willing to buy these stocks. The share prices of these companies are going to go up. That will happen for sure. But then in such a company, it takes time. It takes time for the company to actually reach a level where the growth could be classified as exponential. For example, basically that means that when you bought the stock, from that point to where it is today, let's say 5-6 years down the line, there's a huge growth in the share price. And that has happened because the company has grown. The company is expanded. And the company has the confidence of the market. Maybe its market share has also grown. So those companies are essentially the growth companies, the growth stocks. These companies make profits. They pump the money into the company itself. They are not They don't want to give you the money at this because for any company, the cheapest source of funds for expansion are its own profits. That's easily appreciated. See, if you go and borrow money from, let's say, a bank, or you come out with an issue of bonds for which you have to pay interest to the bondholders, all these, there is a cost. But if you take the profit that you earn, you take the profit that you already earned, that is internal capital. It's already there with you. So if you take that money and you invest that in the activities of the company, in expanding the company is going to do very well with a low cost source of capital. So no dividends, more investments in the company, and more growth. And then you have the cyclical stocks, what we discussed in the last slide in the context of PE ratios. What are the basic industries which are here? Some of them we mentioned in the last slide, some we're mentioning now. Automobiles, steel, cement, heavy industries, banks. So whenever there's economic growth, these companies tend to do well. They're passive when there is a downturn. And then there are defensive stocks. So they remain stable during declines in the economy. So many of the blue chip stocks will fit this bill. So you don't expect great growth here, but you expect steady growth. You expect stability. So quite often people, wanting to make a killing on the market and actually buy less and buy for a low cost price and then sell at very high prices. That's not going to happen in defensive stocks. So these are some of the types of stocks that are there. So before you actually invest, you try to first understand in which of these categories the company that you're interested in comes. You also want to understand what you want. Are you looking for income? Are you looking for long-term growth? Once those things are clear, and those can only be clear when you do goal-oriented investing. So it should be very clear to you what your goal is, goal in terms of the amount of money that you require, by which time should this goal be fulfilled. And then accordingly, you begin to choose the company that you want. Now, what should our strategy be? So one way of understanding companies better is through what is known as fundamental analysis. And fundamental analysis can be broken down into quantitative and qualitative. So a quantitative approach uses the company's financial data to understand the underlying value of the company. Basically, what it does is it looks at every company, every quarter, it publishes its financial statements. So you'll find that on its website, and its balance sheet, it's the balance sheet compared with its performance in the earlier years, its profit and loss, its cash flow statement. All these things will be displayed there if you have the ability to understand it. And I sincerely hope that the discussions that we've had during the course of our classes, particularly the ones where we were discussing accounts. So some of the ideas that we discussed there, I hope they've given you a better understanding of this field, and you feel a little empowered when you look at these financial statements. So essentially here in fundamental analysis, you look at the fundamentals of the company, the type of business that it is in, how it is performing, how it's managing to marshal its resources. Those are the things that you actually look at. And if the analysis shows that the company is likely to do well in the coming years, this is the reason to invest in the company. Remember, when you're investing, the past is basically not what you're interested in. The past gives you an idea about what the company actually does with its resources, how well it uses its resources. But then on the basis of that past history, you project into the future. And the basic premise here is, if the company has been doing well in the past, and since conditions have not changed, the market that it has, it's still there. Therefore, the company will continue to do well in the future also. That is basically the thinking which you have. So you analyze the past, and then you look at the industry as a whole. Then you take a call on what the company is going to do in the future. And that's how any analyst also does it. You look at the company, look at the industry, look at the economy of the country as a whole, and then make a call. Now, the other approach is the qualitative approach. The qualitative approach looks at it from a slightly larger perspective. So what is the business model of the company? What does the company do to earn profits? What are the future prospects of this industry? What is the competitive advantage that the company has? Okay, so we've given two examples here. I'm sure you understand very clearly, just looking at these, what the competitive advantage is. In the case of Coca-Cola or in the case of Microsoft. In both cases, it is something proprietary. In case of Coca-Cola, the taste of its soft drink. That exact taste, that exact feeling you don't get in any other similar soft drink. So anybody who likes that, for those persons, Coca-Cola is a must. They need a Coke. Microsoft, the sort of software products that it provides, the very easy applications that it provides, all of us use it. In fact, we are looking at this PPT that we have out here. This is again a Microsoft product. So these companies have become part of our lives. They have something which gives them an advantage over many other companies, in fact, most other companies. So there are other word processors around. There are other, presentation software around. But this remains the software of choice for a very, very large number of people. And that's all that the company really needs for itself to function. They keep improving the product, and their market, they already have a steady base, and it keeps on expanding. Another two examples would be Relaxo and Asian Paints. Relaxo basically makes footwear. Asian Paints, of course, is paints. Both these companies are essentially addressing the needs of the Indian market. The market is huge. The product that they're making, that itself is required by millions and millions of people. Take, for example, simple Hawaii chappals made by Relaxo. So everybody needs it. It's a huge, huge market. And therefore, when we look at the chances of this company not doing well, we begin to realize that that's pretty tough. If this company can maintain the sort of quality that it has, and can also maintain the prices that it has for each of its products, the chances are that it will continue to sell. And as it continues to sell, it will continue to earn profit. So when we say business model, these are some of the things that we are looking at. What does the company do to earn profit? Suppose we ask this question of Relaxo. It sells chappals. Who does it sell it to? It sells it to a very large market because it's selling, its basic point is low price, decent quality at low price. So the number of people who actually are there, who are willing to buy its chappal, that base, that market base is huge. So given that sort of a market base, the chances are that they will continue to sell and make profit, and that gives you a certain amount of confidence in their future. That is what the qualitative approach is actually doing. And then we look at the quality of management. So does the company have a professional management? So over the number of years that the company has been functioning, So do we see frequent changes in its top management? What is the market buzz about the people that they hire? So all that, because the management ultimately is responsible for deploying the resources of the company and making sure that it makes a profit. So when we do a fundamental analysis, we are essentially looking at both these aspects. We're looking at the actual figures. So what has the company actually done? What is the sort of profits that it's earned over the years? And remember, whenever you do an analysis of financial data, it is never confined to just 1 or 2 years. You look at a long swath of data so that you get an idea about the company over a long period of time. So is it actually consistently making profit? Are its sales expanding consistently? Are its investments expanding? So when we look at the balance sheet, we can see that. When you look at the assets, you look at the liabilities, you can begin to see whether there actually has been growth in its profits. You can look at the sort of dividends they've been giving, the sort of money they've been actually plowing back into their own company. When you begin to look at all those things, you will yourself begin to either gain confidence in the company or begin to feel that this particular company is not worth it. There's no point really in investing. So that's one part. And this part here, this is the part which is going to give you more confidence in the future earnings of the company. And remember, when you invest, your main goal here is to make money in the future. And at the same time, avoid unnecessary risk. So between the two of these, if you begin to understand it properly, you will be better placed to choose companies. This doesn't mean that you're going to make quick money. But what this does mean is that over a long period of time, the probability of you making a good amount of money with that probability is pretty high. That's the basic point I'm trying to make here. Corporate governance. Is the company ethical? So there are many analysts who give a lot of weight to this point. Is the company ethical? See, in the long run, an unethical company is not going to do very well. They may be okay for a short ride, but over a long period of time, there are going to be huge problems with non-ethical companies. Either some sort of investigation may start against them. Once an investigation starts against a company, the perception of the stock market about that company may change. Once that happens, the direct result of that will be that the share prices are going to fall. So corporate governance, does it look after the interest of all its stakeholders, not shareholders, all its stakeholders? The shareholders are just one of the stakeholders. There are the employees, there are the suppliers, there are the customers, there is the community in which they actually work in, there is the government. Everybody, all these different parties have some stake in the company. For some, it's very direct, people who work there. For others, it is indirect, the community in which the area in which the company actually operates. If they're polluting the soil or the rivers or the air in that area, then the community at large is affected. And all these things together make up the corporate governance part of the company, the corporate governance image of the company. And in today's world, if that image is negative, then you can imagine how much damage that is going to do to the company's reputation. So when we look at the future of the company, we also consider the corporate governance, which may seem to be less important or may seem to be an intangible. But actually, it's not really something very intangible. It's something which will come back to hit the company and damage its reputation if it is not done properly. Now, let's look at the quantitative side of fundamental analysis. So what are the important financial statements? We've done this before. There's the balance sheet, which gives you the assets and the liabilities. So this will tell you some basic stuff. It will tell you whether the company is making fresh investments. If it is making fresh investments, you should see an increase in both the liabilities and the assets. So let's say the fresh investments are being funded by its own profits. If that is the case, you will begin to see a lot of growth in the reserves of the company. So the profits that it made in the previous years, they get channelized or they're shown in the item reserves, as I said a while ago, and the corresponding increase in the assets. Something on the asset side would have increased. So it could be the fixed assets, it could be the current assets, but there will be an equivalent increase in the asset side. So what you will basically see is that more money is getting pumped into the company, which is reflecting in its assets. And the assets, remember, are the basis for its revenue creation. The profits that it generates, basically, those profits come from the assets of the company. The second part is, look at the balance sheet, look at the liability side, look at specifically at the capital over a number of years. You can see whether it's raising capital or not. Has it increased? The reserves, like we said, you'll see it here. The moment you begin to see fresh investments, the fresh investments, if they are not because of capital, they're probably because of the profits which reflect in the reserves. But if more and more capital is being raised, then that again will tell you that the company is expanding. And its reflections on the asset side will be there. Then let's look at the second big statement, the income statement. So when you look at the income statement, first, of course, the most obvious thing is the company making a profit. And then what is the return on the capital employed? So the capital employed, remember, is the total funds of the company which are employed or pumped into its business. Now, the total funds that it has is not just the shareholders' funds, not just the, let's say the equity component of the company. It also includes the debt component, whatever it has borrowed. So the capital funds that the company has, it is essentially a combination of both these big components, equity and debt. That's the total amount of capital that the company has. On that capital, what is the return that they are getting? So if I were to take the profit the company has earned, the profit after tax, and then I divide it by the total of capital employed and multiply it by 100, I'll get my return. What exactly is my profit margin on the capital that I'm employing? And the moment I get that return, if I get, let's say, a return of 10%, the question I need to be asking myself is this the best way in which those funds could have been invested? Do I do all this business for a return of 10%? Just a question. Were there better opportunities for me? Or is it something like this, that this is a good industry, these guys have opportunities, but maybe they're not using their resources as effectively as they can? The moment this question begins to come into your mind, you begin to rethink about your assessment of the company. Then you have the cash flow statement. So does the company have a free cash flow? Is cash actually, is it generating cash? Or is it just piling up, debtors? People, are buying from the company, they're buying on credit, and then they are not paying the company. Is that the case? Or is the company actually, does it have a free cash flow? Where it's, a lot of money is coming into the company and the cash is available. If that is happening, if cash is coming in, they have a free cash flow, then you know that this company is doing something right. Because people are then paying the company. And if people are paying the company, then they're receiving something in return. The products of the company, there is something that the company is doing correctly, something that they have, something of value for which people are willing to pay and pay in cash, as against a place where people are taking, let's say, products of the company and not paying the company, either taking it for granted and they're not paying their bills. Then cash from investing. So if the company has certain investments, maybe in other companies or in property or any other asset, is that generating cash? Cash from operations, cash from financing. So essentially what happens is you take the cash flow, you break it down into these three sections: operations, investing, financing. And then you begin to see which of these is actually generating cash. Operations should always be the big earner, the big cash generator, because operations constitutes the business. The investments part of the business is a subsidiary activity. The big one is here. So are the operations actually generating cash? This is the question which your analysis will show you. And you look at this entire, at the numbers of this company, you look at this path, you'll get a very good idea about what the company is doing. So let's take this. Amazon generated cash and used the cash flows to develop Alexa and Kindle. This meant that the profits were low, or the company may even be in loss. So what the point we are trying to make here is that Amazon has these cash flows. And what they've done is they've taken the cash flows and they've used this ready cash in the company to develop these two products. Now, during this period, it's possible that profits were low, or the company may actually have gone into loss because they're diverting things into investment. But why would Amazon have done this? The idea here is that they've used this cash to develop two products, which in the coming years gives it a big profit. That's just one way of understanding how cash flows can be useful. Now, here in this slide, we try to look at some ways of calculating operating cash flows. So one way is you start with net income. So net income essentially is the profit after tax. Another word for that is net income. In cases A and B, the net income is the same, rupees 100 crores. Changes in working capital have an impact on the cash and the free cash flow. So working capital is composed of current assets like inventories and receivables, and current liabilities are composed of payables. In case A, receivables have increased, which means there has been more credit sales. So let's take case A first, and then case B, and then try to understand what has happened here. So let's take the first one. Net income case A is 100. So what we said here was that in both cases A and B, the net income is the same. Now, to understand the cash that has actually flowed into the company, what do? I take the net income and I add the depreciation. Remember, to arrive at the profit, I had reduced expenses from the income. And one component of those expenses was the expenditure on depreciation. Now, since depreciation is an accounting entry, money has not flowed out of the company. Therefore, if I am reducing the profit, I am not actually reducing the cash. all the other expenses that we spoke about, let's say on rent or raw material or salaries, their cash has flowed out of the company. But in the case of depreciation, cash has not flowed out of the company. It's still in the company. So we add back depreciation, 150, less increase in receivables. So receivables have increased. So the amount of increase in receivables is 50. So if receivables have increased, that means there are more people who have bought on credit as compared with my last year. So these people have bought on credit, they are yet to pay. So if they are yet to pay, that basically means that that cash has not come into the company. So I reduce that. And less decrease in payables. Payables are those amounts which I have to pay. Now, if this is going down, that means more money has already been paid by me. Therefore, if there is a decrease in payables, it basically means that I have taken less credit, I have paid. So since I have paid, money has gone out. So both these, the increase in receivables and the decrease in payables, represent outflows. Where this represents a lower inflow, this represents a higher outflow. In both cases, less cash. Therefore, both these are reduced. So if I begin with 100, add 150, I get 250, and reduce the total, the sum of these 100, I'm back to 150. So my operating cash flow in case A is 150. Case B, let's say we take the same figures. All we do is we just change what has happened with the receivables and payables, and we get a totally different figure. So what has happened here? Net income is 100. We add depreciation of 150. We get 250. Now, in this particular case, the receivables have decreased. So more people have paid in cash. So more cash has flown into the company. So we add that. And payables have also increased. Payables increased means I have taken more credit. Less cash has gone out of the company. So that cash is still with the company. So we add that back. And then at the end of it, we end up with operating cash flow of 350. So the relationship between receivables and payables and depreciation, all these three things actually make a difference to the operating cash flow. So when you look at the operating cash flow statement, you are looking specifically at these things. And when you look at an analysis which has already been done, you will find lots of these. Understanding that analysis is important for you. And when you begin to see it in this framework, you will understand it better. So I've summed up what has happened here as there is more outflow of cash. There is less cash in the business. So the free cash flow comes down. And here something else has happened. In this particular case, there is less outflow of cash. More inflow of operating cash flow has gone up. That is the basic thing that we are looking at here. Now, once we have the operating cash flow, we can easily calculate the free cash flow. So we find out the amount of money spent on capital expenditures and reduce this from the operating cash flow. So what are capital expenditures? These are expenditures which have been made for the purchase of assets, which will take cash out of the business for the moment and with the purpose of, like any investment, of earning money in the future. This will give us the free cash flow. So this particular example here is taken from moneycontrol.com. The company which we've used is Tata Motors. This is what some of the figures here are taken from there. And just to give you an idea. So once you have your operating cash flow, if you look at the amount of money which has been diverted to the purchase of assets, you will begin to understand, you will have a figure with you which will give you the free cash flow, the cash which is available with the company for its, let's say, for whatever activity it chooses to fund. Now, when we evaluate a company, I said in the beginning that there are different ratios, different parameters that we actually look at. Now, first was earnings per share. And so after tax income divided by number of shares. This is a very basic thing. Where any company, if it's doing well, that wellness should reflect in its profits. So earnings per share is the first one. Price earnings ratio. So the price per share and the earnings per share. It's a relation between these two things. What is the relevance here? The price is decided by the market. The earning per share, the profit, is a result of the decisions taken by the company. The board of directors of the company has decided to use the resources of the company in a particular way, and it has reflected in the profits and in the EPS. But has the market also looked at it in the same way? Does the market see the profits as sufficient, as being up to its own expectations? That decides the demand for the share. And if there is a demand for the share, then generally the price of the share will tend to go up. So when we look at the price per share and the earnings per share, we're essentially looking at two variables, one external, one internal. And we're comparing these two. So if the market has a positive view about the company and the positive view is reflecting in the way people are buying shares of that company, the result of that will be that the share prices are going to go up. So if the share prices keep going up and the EPS is, of course, it's one figure, so the PE ratio will increase. So when we look at this ratio, we are essentially looking at both factors. I'm reiterating this, how the market perceives the company, that and how the company is actually performing, both. Then you look at the price earnings to growth ratio, then the dividend payout ratio. So what is the amount of profit that the company is paying as dividend, and what is the amount of profit that the company is retaining for its future activities? That itself gives you an idea about the way the company is expanding. If it's pumping more money into the company, and if the company is expanding in the right direction and the industry itself is doing well, then in that case, these investments in the company should reflect in higher profits in the future. If it's giving higher dividends, it's making less, let's say, investments in its own company, then the chances of there being exponential growth in the future are relatively less. So this particular, the dividend payout ratio will give you a window into the future of the company, what you can expect. The current yield, annual dividend, divided by the market price of the share. That's again a handy thing to know, the sort of yield which you are getting on this share. But I would still rate these other four, the ones that we've looked at, as more relevant from your point of view. Annualized holding period yield, the total return divided by the original investment, multiplied by 1 divided by number of years. It can be a parameter that will help you to decide when to sell a stock. But my own particular view here is for you, when you're looking at evaluating a company, look at these first four. These will give you a much better idea about how well the company is actually doing without getting into too many complexities. You'll understand it better that way. Now, the NASDAQ in the US, they have what they call, these are the dozen parameters that they use to basically look at stocks. So the first is sales growth over the years. It's a simple top line analysis. You look at the sales in the income statement and you look at whether these sales have actually gone up from year to year. If the company is actually doing well, if its market share is, let's say, expanding, if its products are acceptable in the market, these sales should be increasing. So that's number one. EPS, what we've already discussed, and its growth over the years. So has the EPS grown from year to year? If it's growing from year to year, that means the prices and the EPS, the relationship there is one in which prices are growing. Let's say the share prices of the company are actually increasing from year to year. Then return on equity, the net profit divided by the shareholders' funds. A few slides earlier, we had discussed return on capital employed, where I said that the total capital employed in the company includes equity and debt, the amount of funds that the company has from its shareholders, plus the amount of funds that is actually borrowed. But when we look at return on equity, we are looking at it purely from the point of view of the shareholders. The shareholders have put in a bunch of money into the company. And what have they actually earned on this? That is the return on equity. So even when we invest in any stock or any sort of investment, ultimately what we're interested in is what is the return on my investment? This is that. Anybody who's invested, what is the sort of return they're getting on their investment? Recommendations. What do the analysts say? So here what I'm doing is I'm not just relying on the figures themselves. I'm also looking at how analysts are analyzing these figures. How do they perceive these figures? And what are they saying? Are they giving positive recommendations about the company? Or are they neutral? Or are they actually saying that this company won't be doing too well in the future? So I'm considering what other people are also thinking about about the company. Why the analysts? Because the analysts, the reports that they generate, these are circulated to millions of people. And it's on that basis that investors quite often take decisions. Now, many investors will be simply looking at the recommendations made by analysts and would be entirely guided by what they say. So what NASDAQ does is, it also looks at what the analysts are saying. Okay, earnings surprises. Has the company outperformed the expectations? So this is something which you normally don't think about. But see, this is equally relevant. Based on whatever facts were available to analysts, and given the amount of time they devote to understanding the industry and the companies that they are looking at, they have a huge amount of information. And on that basis, they come out with very informed decisions about the sort of profit the company should be making. Now, if the company is able to outperform this again and again, it shows that the company management is really doing something well. And if it's doing something well and constantly outperforming the expectations, this bodes very well for the future. In the future, the chances are that they will also be doing well. Then the forecast. The company itself will also make projections, and these can be found in their investor presentations. So every quarter when the results of the company are declared, the company, it could be the MD, it could be someone else, somebody makes a presentation in which they explain the performance of the company, what the company has done well, mostly. If there are any very evident weaknesses that anybody can see, they will try to tell you what those weaknesses are and how they can be overcome. And all said and done, they'll give you a complete idea into the way the company has performed over the quarter, along with comparisons with corresponding quarters in the last year, with the performance for the whole of the financial year last year. All those comparisons will be made. And if you listen to one of these presentations, it will give you a full analysis of their own performance, and will also give you what they are forecasting for the future. So what does the company itself say about itself? Where do they feel that they are going? That is relevant here. Now, earnings growth and net profit. This is a simple one. Then PEG ratio, what is the growth in EPS over the years? From year to year, how has the EPS grown, and what has been the price growth of the company, the share price growth of the company. And then they look at industry earnings. So if the profit of the company is, in percentage terms, is, let's say, 10, what is the profit of its peer group, other companies operating in the same industry? So let's say that if Relaxo Chappals has a certain growth, how is Paragon doing? If Asian Paints has a certain good growth, let's say, how is Nerolac doing? So we look at other companies who are faced with the same challenges because they're in the same industry as the company that you are analyzing. And then you begin to compare this company with them and begin to understand how well this company of yours is doing. Then there are other parameters which NASDAQ looks at. But for us, we don't need to look at this, considering that we're just trying to understand this from a beginner's perspective. Days to cover, insider trading, weighted alpha. Let's leave that to the professionals. Let's focus on the basics here and try to understand these. Now, let's look at some of the key ratios. We've talked a lot about these ratios. We've talked about EPS, earnings growth, return on equity, EPS growth, all these things, sales growth. Many of these things were there in the NASDAQ dozen. So what I did was, I just took the data from moneycontrol.com. This is a site that you can use with a great amount of profit, if you really are interested in this area. And I took the data for some companies which have been doing well. So I took Dr. Lal Path Labs. So basically, they run a chain of pathological laboratories, and they've been doing particularly well. They have a huge investment in the sort of computer systems that they've created. They've automated analysis of pathological reports, and they're doing very well there. So if we look at the sales growth of this company, you start at 18, it's around 15.98, 19, it's 14.76, March 20, 9.89, March 21, 15.82. Remember, this is a COVID year, so one can very well imagine that this would be a year in which the work volume for Lal Path Labs would have been higher than usual. But what you can see is that there is steady sales growth over the 4 years that I have taken the data for. You look at EPS growth, earnings per share growth, 9.49 in March 18, 15.58% in March 19, 14.11 in March 20, and expectedly 25.25% in March 21. Obviously, this has been, let's say, given a boost by COVID. EPS itself, earnings per share, March 17 is 18.76, 20.54, 23.74, 27.09, and 33.93. So more or less a continuous increase, which basically is a very, very positive metric. Earnings growth, once again, this is basically the growth in profits. So we see 10.59% in March 18, 14.31% in March 19, 3.53% in March 20, 23.57% in March 21. And once again, you feel that this is a company which has its profits have actually grown, except for this one bad year here, March 20. It has double-digit growth in all the other years. And then when you look at return on equity, from a shareholder point of view, it seems to have done excellently well. So it's above 20% in all these years. And what more exactly can an investor expect? So basically, when you look at these key ratios, it gives you a window into the functioning of the company. Now, what I propose to do now is that we stop the lecture here, have a look at these, and we get back to this tomorrow, and we discuss this in more detail, looking at the specific problems that you may have come up with when you looked at this presentation. I'll put this on our group, have a look at it so that we can take it forward tomorrow. I'll end it here, and good night to all of you.